Hey, how's it going, guys? In this video, I will share with you guys 4 very important charts which look amazingly similar to what is going on in this market today. And even more importantly, I will use these 4 charts to try to answer the question that everyone is asking these days, where the market is gonna go next. So please make sure you watch through the whole video so that you won't miss out anything, because there are tons of value in it. Alright, let's get started. The first chart I want to share with you is the Dow Jones Index chart from 1929, the famous big crash before the Great Depression. If we look at the chart of 1929, the market topped in the early of September and started crashing down. The crash looks very similar to this year's COVID-19 crash. The entire drawdown was about 50%. November was the market low. After that, it started going back up. It had a little V-shaped recovery at the beginning and then slowly rallied back up. It looks a lot like a healthy bull market back up again and all the way retrace back to the 50% Fibonacci retracement level. Once the market hit that 50% retracement level, it stayed there for about 2 weeks time. Then it started going down. And that turned out to be a long, painful bear market. From the 50% retracement level, the market dropped another 86%. In total, that was an 89.6% drawdown from the 1929 peak, and the entire bear market lasted about 3 years. The second chart I want to share with you is the famous Japanese stock market crash back in the 1990s. Japan was in a huge bubble around the late 1980s. Back to that time, Japan was the second largest economy in the world, and the bubble eventually burst in January 1990. So let's see what the chart tells us. Well, the initial crash brought the market down 28% within a 3-month period of time. Then the market rallied back up to the 50% retracement level. It tested the same level twice and eventually crashed again. The second crash was even worse than the initial crash. It dragged the Japanese stock market into a long bear market. It took the market down for another 57% from the retracement level. In a total 2.5 years, the Japanese stock market crashed 64% from its bubble peak. In fact, even until today, after 30 years, the Japanese stock market hasn't really fully recovered from the crash yet. The third chart I want to share is the Nasdaq back in the 2000 dot-com bubble. First, it had its initial crash in March, and within 2 months, Nasdaq crashed 34%. Then the market started its retracement back up. It took about 3 months for Nasdaq to hit the 61% Fibonacci retracement level, retested, failed to break the resistance level, so the market started another leg down, and it turned out to be a long, painful bear market that lasted for 2 years. The total drawdown from the bubble peak was 83%. Alright, the last chart I want to share is the S&P 500 chart back in the 07-08 global financial crisis. Again, the same thing, the market peaked in October 2007 and started crashing down. The initial crash took the market down 19% within 3 months. Then the market retraced back to the 50% Fibonacci retracement level, failed to break it, and sent the market back down to a much bigger crash, and eventually led to a bear market. The whole bear market took about 1.5 years, and the S&P has lost almost 60% of its value. Alright, the reason I wanted to show these 4 charts is because these are the 4 of the most famous bear markets in our financial history, and they all look extremely similar to what is happening today. I always believe that studying the past is the most reliable way to prepare for the future. After going through these 4 charts separately, let's put them together, compare 4 of them, and see what are the secrets these charts can show us. First of all these 4 charts follow exactly the same pattern, which has 3 different stages. The initial crash stage, this is the stage where everyone is rushing to sell. And then followed by the hope stage, the central banks decided to stimulate the market and the FOMOs start chasing to buy the dips. Eventually, it will end up with a much bigger crisis stage, and this is the stage where the reality kicked in and the real bear market started. If we take the average value of these 4 bear markets, in the crash stage, the average drawdown was 32.4%, and it lasts about 3 months. During the hope stage, all these 4 charts have retraced back to either 50% or 61.8% Fibonacci retracement level. The rally would normally last about 3.5 months. But the real pain comes from the crisis stage. In this stage, the average drawdown was 69%, and it lasted 21 months, almost 2 years. This is the S&P 500 chart today. If we use the same framework to analyze what is happening today, we can see that they look extremely similar. First, we had the initial crash stage. The market topped around early February and then reached the bottom at the end of March. The entire crash was 34% in about 2 months' time. And then we entered the hope stage. It looks like a V-shaped recovery at the beginning, but the market has quickly lost the momentum and started consolidating. After about 2 months' time, we hit the 61.8 retracement level. In fact, we tested twice, but both failed to break it. Also, if we compare the volume, we can see that during this short-term uptrend rally, the volume is actually in a downtrend. This is a sign that the investors, especially the institutional investors, may not be fully convinced by this rally yet. So where are we right now? Mark Twain once famously said, "History doesn't repeat itself, but it does rhyme." If we compare our current market condition with the 4 historical bear market average performance, it clearly shows that we have completed the initial crash stage, it perfectly matched the historical average data, and now we're at the end of the hope stage. And there's a high probability that we're heading to the crisis stage in 4 to 6 weeks. Well, of course, no matter how much our current market resembles the historical bear markets, nothing is guaranteed in the financial world. And that is what trading is all about. Trading is about trading the probabilities, not the certainties. The market could break the 61 retracement resistance level and make a new high. It's definitely possible. However, it is not probable. The things are possible, they may not be probable. Based on what we learned from the past, also combined with everything happening in this world right now, the market definitely has a higher probability heading to the downside. In fact, many legendary fund managers have already expressed their bearish view publicly recently. So now the question is, what should we do? When exactly can we know if we're going to enter the crisis stage? There are 2 important indicators I'm watching right now that could potentially show me exactly when we'll enter the crisis stage. First is the bond market. If you're a new trader or investor, there's one extremely crucial thing you should know. When the stock market and the bond market are sending different signals, follow the bond market, because the bond market is where separates the smart money and the FOMOs. The stock market is the total sum of human behavior, where the bond market is the total sum of the hard economic truth. So the chart I'm watching right now is a 2-year yield chart of the US government bonds. After a massive crash, the 2-year yield has been consolidating in the tight range for about 2 months now, and it looks like it's about to break the range and head lower. If the 2-year yield breaks this range and head to 0, that would be one of the best signals telling us that we're heading to the crisis stage. The second indicator I'm watching right now is the dollar. A strong dollar is never good for the economy, especially during a crisis. The global demands for dollar has been increasing dramatically during this COVID-19 pandemic. If the Fed fails to control the dollar, it will definitely drag the stock market down, and as well as the entire economy into a much bigger trouble. So here's the dollar index chart. After a huge rally, dollar has been consolidating in a closed triangle pattern. This is the typical pattern indicating that the dollar is about to make another huge move in the next couple of weeks. If the dollar break out from this triangle pattern and go higher, that would signal the stock market will potentially go down and enter the crisis stage. So these are the 2 main indicators I'll be looking at for the next 4 to 6 weeks. On top of that, I will also look at the volatility index chart, the VIX. 31 is the key level to watch, because this is the level where the majority of the professional option trader believe that everything will go back to normal if the VIX drop below 31. So that's the key level I will be also watching. But my main focus for the next 4 to 6 weeks will be on the 2-year yield chart and then the dollar index chart. Alright, that will be the end of this market analysis. I will keep you guys updated on the market as soon as possible, and hopefully my videos could help you guys navigate the market with more confidence and more perspectives. If you are new to this channel, my name is Vic. I upload market analysis videos every week to share some of my insights on what is going on in the financial market, and also what are the trade ideas or investment opportunities that you should pay attention to in the market. If you are interested in the financial market and find that my videos have been valuable to you, please consider subscribing. Thanks for watching, guys, and I will see you guys next time.